Welcome back, you legends. I'm Dr. Cal, and let's get right into this video. We had very interesting market action. We had all the three indices gap down at the open. We sold off and then we rebounded and we basically broke even towards the middle of the day, and then we sold off again towards the end of the day. The S&P 500 was down 0.45%, the Nasdaq 0.15%, and the Dow 0.67%. The Nasdaq was buoyed by rises in Amazon and in Tesla, as well as some of the semiconductor stocks, while the Dow and the S&P 500 were weighted down by the financials and the healthcare stocks going down, as well as the industrial sector. Now let's take a look at the map. A bit of a weird mix today, guys. We have consumer defensives doing okay. We have cyclicals also doing okay, which is kind of strange. When we see consumer defensive doing well, we would like to see cyclicals weaken. Okay, they're the opposite. Consumer defensive is defensive. It's the flight to safety sector, and then consumer cyclical, also known as consumer discretionary, is where you go when you trust that the economy is going to grow and that people are spending like crazy. Okay, so this is kind of a strange development that we had. Again, we have semiconductors doing okay, semiconductor equipment and materials doing okay. Big tech companies flat except for Google. Google was actually down. And then we had banks down, healthcare companies down, industrials suffering as well. Real estate flat on the day, basic materials also basically flat, and then we have energy closing flat as well. And let's take a look at the different sectors. The best performing for the day were consumer cyclicals, inching up by a little bit over a half percentage. Then we had energy, basic materials, and consumer defensive barely hanging on there. Technology basically closing flat, utilities slightly down, real estate slightly down, and then we have the biggest losers for the day being communication services, industrials, financials, and healthcare. The communication services sector got really weighted down by that 2.5% loss or 2.3% loss by Google. Now this is a really weird mix, right guys? When we see consumer cyclicals leading, we would also like to see technology lead. We would like to see industrials lead, communication services lead. We would like to see risk on sectors lead together and then lag together. So this is a weird mix. It just basically means that the market really has no idea what it wants to do, and we kind of saw that in the price action, right? We gapped down after that horrible inflation report came out at 9.1%, the highest reading in over 40 years, and then we inched our way up to fill the gap. The futures market is open as of right now. It's 3 a.m. Eastern time, and we're down on all three major indices, and the VIX is spiking up again. Okay, so this is not looking good. It looks like that the market yesterday was just trying to digest that inflation report that came out. We'll see decisive action today, likely to the downside. Okay, what happens when these huge economic reports drop, guys? We tend to see volatility on the day of the drop of the economic report, and then the next day we tend to see the market make a decision either to the upside or to the downside, and that decision tends to stick. Okay, we tend to see the market stick to that decision for a few weeks at least. Now this is a daily chart of the S&P 500, guys, and just look at that. We gapped down yesterday, opened 1.5 percentage points down, and then we moved up to fill the gap, and then we sold off again towards the end of the day. This is typical, really. It's nothing really that strange. We had decent volume, primarily because of that huge gap down on the day. But again, this is not the easiest chart in the world to read right now. We're just sitting right here at this level of support at the $375 level. Okay, we just bounced off that level. If we see this support break today, there is nothing stopping the S&P 500 from going all the way down to fill this gap right here at the $365 level. So if we do break 375, we're going to lose $10 just like that, because we have this absolutely massive gap right here. So we'll see what happens today. On the smaller time frames, on the 4-hour chart, we do have a bearish crossover right here. Okay, the last time we saw a similar bearish crossover was back here, and then we had this absolutely insane sell-off come in. Interestingly, guys, this sell-off was actually caused by the inflation report that came out a month ago, and this report is significantly worse than that one. It's way worse than that, but we're not seeing the selling intensify just yet. Okay, so be very, very careful. We do have this gap level right here that I marked in a previous video. That will take us down to $350, and that is to fill this gap right here. Right here, this gap, okay? We have a beautiful gap right here that we can even see on the weekly chart. Bam, there you go. Look at that beautiful gap. And it also happens to be sitting right smack on top of that 200 weekly moving average. We've been talking about this weekly moving average for a while now, and as it is entering the selling zone, the market would like to gravitate towards a technical development like this, okay? Especially on weakness that we're seeing right now. And there are a lot of signs that the market is weak, including the fact that we have the put to call ratio spike again, and this has been really bad news. Every single time we've seen the put to call ratio spike, we've seen the market begin another leg to the downside. So be very, very careful around here, guys. We have another sign of weakness on the VIX. We had this support line right here. We've touched this support line once, twice, three times, four times. We've broken through the fourth time, but then again we broke and then we came right back up above the support line. So this is a false break. This is definitely looking like 100% a false break. And when we do get a false break like this in volatility, the results are usually really, really ugly. I mean, look at that. We had a false break right here on the 10th of February, and then we had a massive spike in volatility and a second spike. In 10 days, guys, back here in February when we had that false break, in 10 days, we saw the market decline by 10%. It was right here on the 10th of February, okay? And the market dropped by over 10%. And it was in 10 days. Look at that. Now let's jump into the triple Qs, the Nasdaq. Now on the daily chart, we can see that the Nasdaq actually rallied towards the upper half of the descending channel. Okay, the last time we had this happen was right here, and then we sold off. So this looks like prime target for bears to short. In fact, I did open a short position right over here. Why? Because I saw a double top formation forming. We had two tops right here. We rejected twice. And so it would make absolute sense for the market to at least go and test the support line again and perhaps fill this gap. Let's take a look at the 10-year yield. The 10-year yield saw a little bit of a spike over 3%, and then it went back down. It calmed down. Now it's sitting right around that 3% range. The MACD is starting to curl over. If we look at the 4-hour chart, for example, we can see that the MACD is trying to cross again. If it does cross, and if we do see another leg up and the 10-year yield, that's going to be very, very, very bearish for the stock market. So it's going to be really interesting to see what happens with the 10-year yield at these levels. It's just sitting at a really critical level here at the 3% target. And if we take a look at the dollar index. The dollar index has been absolutely hammering the stock market. This stratospheric rise in the dollar index was partially responsible for the significant downside that we've been seeing in the stock market. The dollar has been trading very, very strongly against the euro. In fact, the dollar to euro ratio has hit 1. So $1 equals 1 euro for the first time in over 20 years. That is absolutely insane. And it's because of the absolutely pathetic incompetence of the European Central Bank. Europe is seeing some of the worst inflation in the history of the European Union. It is so bad right now, and this is driving the strength in the dollar. So despite the fact that we're seeing inflation, what you would expect during inflationary times is for the dollar to collapse and for gold to perform well. But it's not happening, and it's because inflation everywhere else outside of the US is actually much, much worse than the US. So we're seeing sort of flight to safety to the US dollar. The US dollar is also the reserve currency of the planet. So everybody uses dollars to trade commodities, to buy and sell commodities. So when commodity prices jump, like we've seen in the past couple of years, naturally we will see a lot of countries gravitate toward accumulating US dollars to buy commodities. Now, interestingly, we've been trading inside of this beautiful channel on the dollar index. Now we're sitting at the very upper edge of that channel. We could see another up day, perhaps today or tomorrow. I would not be shorting the US dollar, absolutely not. What I would be doing is waiting for the dollar to drop all the way back into the bottom red zone right here, and then opening another long position. Okay, you can trade the US dollar using the UUP ticker, the Invesco DBUSD Index Bullish Fund ETF, and I would use the DXY, the actual index, as my baseline for technical analysis. Okay, let's take a look at Apple now, guys. Look at Apple. It's been trading inside of this beautiful, beautiful descending channel. We've broken out of this resistance line, this descending line. So we've basically been wedging here, guys, okay? And we've broken out of this line. Usually what tends to happen when we see things like that, guys, is we see a full measured move take place, and a full measured move would be from the bottom to the top of this move right here, the previous move that we've had. And then we take that, we move it from the bottom to the top. Look at that. The bottom of this candle right here to the very top right there. So ideally, the way you would trade this is you would buy Apple on the break of the support line right here, okay? So as soon as you see a break of the $140 level, you would open a long position, and then you would take profit at the top edge of this full measured move, which would be around $148. And look at that, bang, we hit that a couple days ago, and then we reversed. So this is an absolutely beautiful technical structure, and that's how you would trade it, right? You would not go long here, you would not buy here, because at this level right here, you have no guarantees that the market would actually bounce. It could just continue to sell off, okay? So you would wait for the break, and the break occurs at $140, and then you take profit at $147. And if you go into this trade using options, you would make a really nice profit. In fact, depending on how aggressive you are with your option expiry, you could see as much as 2x, 3x profit. So up to 200% profit on this trade. So this is Apple, and now we're seeing a beautiful reversal right at the top. So the way you would trade this now, okay, and I'm not saying that you should do this, okay, this is just how I would trade this probably, is I would open a position right here at the top, okay, and then I would probably pick a really long dated option, really long dated option, and just ride it out, wait for Apple to go into this red zone again towards the bottom end of the channel, and I'll take profit there, okay? So that's how I would do it as a conservative trader. I would open a position here, probably an option in September, somewhere around here, and I'll take profit when Apple hits this bottom zone, okay? And an even more conservative way to trade this is to open a spread instead of a simple put option, okay? So for example, you would buy right here a $120 put option on Apple, and then you would sell a $110 put option on Apple, okay? So if Apple closes right here below $110 on the 30th of September, you would make a $10 profit, okay? And depending on how much you've paid for that spread, it would probably cost you about $2.50 or something like that. So that would be a 4x profit from that, okay? A 4x profit. Again, guys, I'm not a financial advisor. I'm not saying that you should do this. It's just an example of a trade idea, okay? Now let's take a look at Google, and we're seeing weakness in Google again. And Google's been trading within this range. We've had a triple rejection at the $2,400 level on Google, okay? We've had rejection once, twice, and then 3 times. So we've been trading within this range now for quite a while. A touch of the $2,100 level right here would make sense right now, as we're seeing weakness in Google. And in fact, I would expect, okay, a bearish crossover to occur within the next couple of days on Google, on the MACD. And as soon as we get the split out of the way on the 18th of July, in fact, I would expect Google to significantly weaken. And this does look to me like a massive bear flag on Google, right? So a bear flag would look like this, okay, right? So this is the flag, boom, and this is the flagpole. Right here we have the flagpole right here, and we have the flag really well defined right here, okay? And usually when we see something like this develop, the full measured move, how you would measure that is you would take the absolute top, you would go to the top of the flag right there, something like that. You would take this again, top to bottom, and that's how you would extrapolate a full measured move. That's the conservative way of doing it. An aggressive way of doing it is you would put this right here at the top, you would put this at the bottom, right? And then you would do that again, okay? So this is a traditional full measured move, and it would take us to $1,700. Let's see. Oh, look at that. We have a cluster of price action right here. So actually, this makes a lot of sense as a level for Google to hit. But again, as a conservative trader, I would probably target $1,900 instead of $1,700, right? So I would target this cluster right here. But again, guys, that's just me, and this is not financial advice. Now, let's take a look at Tesla. Again, look at that. All of these high-flying stocks that we've seen everyone pile into in 2020 and 2021 are now flagging and making absolutely massive flags. Look at that. Massive flag right there, top to bottom. Look at that. $400. And again, we've talked about this level a lot. Look at that. A cluster of a price action right around $400 for Tesla. And if we look back, like if we take a look at the weekly chart, this does look to me like a Wyckoff distribution. A Wyckoff distribution, guys, is a trading pattern or a technical pattern that looks like consolidation but is actually distribution. And the difference between consolidation and distribution is when a stock consolidates, it ends up moving up. So consolidation is driven by buying, and then distribution is the opposite. Distribution is tight price action that's actually driven by selling. And that's what we're seeing here. We're seeing a blow off top right here, this massive blow off top. And now we're seeing distribution, okay, with lower highs. And we've now been flagging for several weeks. In fact, 2 months now we've been flagging. So this is a massive bear flag. And the longer the price action continues to tighten, the more aggressive the move at the end of this tightening is, okay? So when we see price action bunch up like this for a long time, like we've been seeing for the past couple of months, usually the move afterward is very violent, either to the upside or to the downside. But I would definitely lean towards the downside, considering the bearish structure of the daily chart, the weekly chart, and the general state of the stock market, right? So this level right here makes total sense. We have the 200 weekly moving average setting right here. We have this cluster of price action right here. So $400 makes total sense on Tesla. The timing is going to be really difficult on this one, guys. It could go to $400 in September, maybe October, maybe next year. So the timing is going to be really difficult on this one. Now let's take a look at the XLF. XLF is the S&P 500 financials ETF, and then again, look at that, massive bear flag. We've been flagging. This is the flag pole, and then we've been bunching up towards the bottom end of the pole. We're sitting right on top of that 200 weekly moving average on the financials. And we have this really big gap right here at the $25 level. We have banks reporting today before the market open, and tomorrow as well on Friday. So we'll see what happens. I do not tend to be bullish at all, especially since JP Morgan's CEO Jamie Dimon was talking about a economic hurricane coming our way. So if the CEO of the biggest bank in the US is telling you, guys, a hurricane is coming, you better get the hell out of the way and just let that hurricane pass through, okay? So I'm absolutely not going to step in front of this freight train, this avalanche, whatever you want to call it, this tsunami of selling that's going to be coming, but we will see. We will see what happens. Now let's take a look at XLE, the energy ETF for the S&P 500, and we're now sitting at the very bottom edge of this upward channel. If we see the 10-year yield begin another leg to the upside, we will definitely see energy jump back up. And then again, if we see some weakness in the US dollar, a pullback in the US dollar, this will drive oil prices up, and in turn will drive the prices of energy stocks up. On the daily chart, we're getting really close to a crossover on the MACD. If we take a look at the 4-hour chart, we've actually had a crossover right here, and we've had multiple bottoms now. We've had 1, 2 to a double bottom with higher lows on the MACDs, despite this being a lower low, right? So we have a divergence right here, higher low there, and then a lower low here. So energy does look like it's trying to base right here and form a launching pad to go up again, okay? But we will see if that happens or not, okay? If inflation begins to top, energy stocks will get hammered. We're not seeing signs of inflation topping quite yet, okay? We're seeing some signs of the economy slowing down, but we're still not seeing that in inflation. We need to see inflation come down meaningfully. Now let's take a look at the daily chart for oil. This is crude oil, and we're sitting at a really critical level for oil right here at the $100 level. In fact, we've broken down below the $100 level today. We're now sitting at 97 bucks. And this is the last support we have here, guys. We've had a lot of reactions here at these levels, and this is the last support that we've got. So I do expect oil to make a stand here, doodle around for a bit, and then make a decision either to the upside or to the downside. Okay, now let's take a look at gold. Gold has been absolutely hammered recently. Look at this waterfall sell-off, absolutely ugly sell-off, and it's been driven entirely by the strength in the dollar index. So if the dollar index begins to top right around here and pull back again, we will definitely see gold stage a bounce back up. On the longer time frame on gold, on the weekly chart, we have this really ugly double top formation right here. We have a top right here, another top there with a negative divergence on the MACD. So this is looking really ugly, a double top, and then in what looks like again a Wyckoff distribution with a blow off top right here, and then a complete reversal. So we will probably see gold continue to weaken as long as the central banks of the rest of the world continue to screw up, especially the ECB, the European Central Bank. But we will get to a point, guys, where the Europeans screw up so much that they go into one of the deepest, worst recessions, probably some political unrest, especially in the southern countries, where their debt to GDP ratios are so high, they have so much debt that even a half percentage point increase on the yields by the central bank will crush European economies. That will eventually drive us into a deep global recession, and gold tends to perform really well during global recessions like what we had during the global financial crisis back in 2008. Now let's jump into a new chart that I want to show you guys. This is the this chart shows the open interest on the puts and calls for the week. We clearly have a couple of critical zones right here at the $370 level and the $380 levels. A lot of puts open right here. These put walls tend to act as somewhat of a support, and again, call walls tend to act as somewhat of resistance, right? Because what happens is market makers tend to be net sellers of options, so they do not want these options to expire in the money. They want these options to expire worthless. So ideally what they would like to do is to close the market right here, smack in the middle between all of these spikes. So between $380 and $390. In fact, Max Pain is at $384. Max Pain is the level at which the market closes. Market makers make the most amount of money, okay? Option sellers make the most amount of money if the S&P 500 closes at $384 by the end of the week. I'm very skeptical that we will close at $384. In fact, I'll be watching really closely today. If we see some weird price action early in the day in the market, if we see some surprise strength, we will probably see a lot of these put options getting closed out, right? And as soon as this put wall is out of the way, we will see the market sell off very quickly, right? So that's the type of manipulation that you could easily expect from these market makers, right? They play around with the indices, they push the price up a little bit to get rid of this put wall, and then they crash the market, and they would probably stop right around here, just a buck above the $370 level. So these put options expire worthless. The last bit of news I have for you guys is this. Today, producer price index at 8:30 a.m. Eastern time. Again, if this figure comes in higher than expectations, I would expect significant weakness in the stock market if we see the jobless claims come in below expectations. So if the jobs market continues to be hot, and then we have producer price index and the consumer price index also continue to be hot, that only gives more reasons to the Fed to pick up the pace on raising rates faster and higher, right? And that would be very bad for the stock market. On Friday, we have retail sales coming in, and the 5-year inflation expectations, and the consumer sentiment index. So a lot of things could go wrong on Friday. July 15th also happens to be option expirations date, right? So a lot of options expiring. We have all of this negative news, and historically speaking, 15th of July has been a really bearish day, okay, in general. So a lot of negative catalysts coming in, and very weak seasonality on the 15th of July. So I do expect a lot of shenanigans on Friday. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye bye.
Oh, wow.